Most people quit compounding at the exact moment it is about to start working. Not because they are lazy, not because they do not understand money. They quit because the beginning of investing feels like nothing is happening. You put in $100, then $200, then $500. You check your account, it barely moved. And after months, sometimes years of watching a number crawl forward by pennies, most people give up right before the part where everything changes. Today, we are going to talk about that turning point, the real number where compounding stops feeling like a waiting room and starts feeling like a machine. And the math behind it is simpler and more emotional than most people realize. Here is the problem with the early years of investing. Say you put in $300 a month at an 8% average annual return. After the first year, your account might have grown by maybe $120 from returns alone. $120. That is not exciting. That is a grocery run. That is not enough to make someone feel like their financial life is changing. Your effort, the actual money you are putting in every month, is doing almost all the work. The market is barely helping you yet. And this is the exact stage where most people decide investing does not work, or that it is too slow, or that it is not worth the sacrifice. They are not wrong about how it feels. They are wrong about what it means. If you want money explained with real math, simple examples, and no fake guru hype, subscribe to American Moneyline. We break down the numbers nobody else bothers to explain clearly. And we show why ordinary money decisions can become powerful when time and math are allowed to work. Now, let's get right back into this one. Let's meet someone real. Call him Danny, 32 years old, works a solid job outside Columbus, Ohio. Rent takes a real bite out of his paycheck. His car payment shows up every month whether he feels ready or not. Groceries cost more than they did 2 years ago. Insurance quietly rises. A few subscriptions keep charging his card because he keeps telling himself he will cancel them later. Inflation is eating into raises that were already small to begin with. Danny is not rich. Danny is not broke. Danny is exactly where millions of working Americans are, trying to save, trying to invest, and mostly wondering if any of it is actually going anywhere. In Danny's first few years of investing, almost all of his account growth comes from Danny, not the market, him. Every month he puts money in, and that is basically what moves the number. The returns are real, but they are small because the base is small. This is the most discouraging phase of the entire journey, and it is also the most important because this is where habit gets built. Danny is not being rewarded yet. He is just showing up. He is building the part nobody claps for. He is creating the base that future compounding will need before it can actually do anything impressive. And this is where people misunderstand the game. They think compounding should feel powerful immediately. They hear stories about people getting rich through investing, so they expect the account to start moving in a dramatic way after a few months. But compounding does not work like a paycheck. It does not reward you evenly every 2 weeks. It spends years looking almost boring, almost useless, almost invisible. Then, once enough money is built underneath it, the same math that once produced tiny results begins producing numbers you can actually feel. Now here is where the story turns, because there is one number where the entire feeling of investing changes. Not because the math changes. The math never changes. It is the same formula the whole time. But at a certain point, the results of that formula become impossible to ignore. That number is $100,000. Here is why $100,000 is the real explosion point. At an 8% average annual return, $100,000 can generate around $8,000 in a single year. Break that down, and it is about $666 a month on average from the market alone. Not from Danny's paycheck, not from him skipping lunch, not from him picking up a side gig, from the money itself working. That is the moment compounding stops being a theory and starts being something you can actually feel in your financial life. Now, let's be clear about something important, because this is where people get confused. It is not the 8% that is magic. 8% was always 8%. What changed is the base. An 8% return on $1,000 is $80. An 8% return on $10,000 is $800. Helpful, but still not life-changing. But an 8% return on $100,000 is $8,000. Same percentage, same formula, completely different result. amount. The formula does not change, but the effect becomes more powerful because the base gets bigger. And once that base is large enough, the exact same percentage that used to produce pocket change starts producing real, noticeable money. This is why the first $100,000 is often called the hardest stretch in investing. Not because the market is harder to predict in the beginning. It is because in the beginning, the investor is doing almost all the heavy lifting. Danny's monthly contributions matter more than his returns for years. He has to keep showing up, keep contributing, keep believing the account is going somewhere long before the account gives him any real proof. He has to keep investing while the number still looks unimpressive. He has to keep going while his friends are upgrading cars, taking trips, buying new things, and making it look like spending is the reward for working hard. That emotional part matters more than people admit, because getting to the first 100,000 is not just a math problem. It is a patience problem. It is a behavior problem. It is a self-control problem. Danny has to look at a small investment account and believe that one day it will become something meaningful. That is hard. It is hard because every month there is something else that feels more urgent than the future. A repair, a medical bill, a birthday, a weekend trip, a bigger apartment, a new phone, a payment he forgot about. Life is always asking for the money before the future can get it. But if Danny keeps going, something starts to change, slowly at first, then noticeably. In the early years, most of Danny's growth is contributions. A small slice is returns. As the account grows, that return slice gets bigger, not because Danny is suddenly investing more aggressively, but because there is simply more money in the account for that same 8% to act on. By the time Danny approaches $100,000, the returns are no longer a rounding error. They are a real monthly number, showing up alongside his own contributions, sometimes even exceeding what he personally put in that month. And that is the psychological explosion. It is not just seeing a larger number on a screen. It is realizing that the money is finally starting to help. Before that point, investing can feel like pushing a heavy car from a dead stop. Every inch takes effort. Nothing feels smooth. You are sweating, and the car barely moves. But after enough pushing, the wheels start rolling. The same effort suddenly moves it farther. That is what the first 100,000 can feel like. You're still pushing, but now momentum has joined you. This is also why quitting early is so expensive, even when the account looks small. When someone stops at $5,000, $10,000, or $20,000, they are not just giving up that amount. They are giving up the future base that could have grown into something powerful. They are giving up the stage where compounding would finally start to become visible. They are walking away during the boring part because they never reached the loud part. And the cruel thing is, from the outside, it looks like nothing was happening, but under the surface, the foundation was being built. Now, an honest pause here, because this channel does not do hype. 8% is an average example, not a guarantee. Markets do not move in a smooth, predictable line. Some years, the return might be 20%. Some years, it might be negative. Some years, it may feel like your account is standing still or even moving backward. The 8% number is used for illustration, not as a promise about what happens in any single year or even any single decade. Compounding is real, but it is lumpy, unpredictable in the short term, and it demands patience, precisely because it does not reward you on a schedule. This is why the people who win with compounding are usually not the people who feel smart every month. They are the people who can keep going when the account feels boring. They can keep investing when the headlines are scary. They can avoid panic selling when the market drops. They can avoid turning every raise into a bigger lifestyle. They understand that the real goal is not to feel rich today. The real goal is to build a base so strong that future returns finally have something meaningful to work with. There is a darker side to this same math, and it is worth saying clearly. Compounding does not only work in your favor, it works exactly the same way in reverse. Credit card debt compounds. High-interest loans compound. Lifestyle inflation compounds too, just in slow motion. The same math that can turn $100,000 into $8,000 of growth in a year can turn a few $1,000s of debt into a number that refuses to disappear. Compounding is not good or bad. It is neutral. It simply amplifies the direction you are already moving in. That is why debt can feel so emotionally exhausting. A person pays $200 toward a credit card, but the interest keeps adding itself back. They feel like they are moving, but the balance barely changes. That is negative compounding. It is the same machine, but it is running against them. This is why building wealth is not only about investing. It is also about protecting yourself from the wrong kind of compounding. High-interest debt, unnecessary car payments, constant lifestyle upgrades, and spending habits that grow faster than income can quietly destroy the same future you are trying to build. So here is the real takeaway. Compounding does not explode because the formula suddenly gets stronger. It explodes because the base finally gets big enough for that same unchanging percentage to hit differently. The first $100,000 is hard because you are building the base almost entirely on your own. Your paycheck is doing most of the work. Your discipline is doing most of the work. Your patience is doing most of the work. But once that base is built, the market finally starts showing up beside you. And that is when the math stops feeling boring. It starts getting louder. The same return that once gave you $80 can one day give you $8,000. The same percentage that once felt pointless can become meaningful. The same habit that once felt small can become the reason your future looks completely different. That is the part most people never stay long enough to see. So if you are still early, do not judge compounding by the first few years. That is not the explosion. That is the fuel. That is the quiet part. That is where the machine is being built. The first dollars feel weak. The first returns feel small. The first progress feels almost invisible. But every dollar you keep invested becomes part of the base that future returns will stand on. And once that base reaches a serious number, the same math that felt slow can suddenly feel powerful. This has been American Moneyline. The numbers do not lie. They just take their time telling the truth.